Hello and welcome to State of the Economy. 2016 has brought with it a number of worrisome developments on the global economic front. There's a global slowdown. Many experts, economists are even suggesting we could be looking at a near recession situation in 2016. The Chinese economic slowdown and the financial market meltdown in China has created a lot of fear in the emerging economies, among the emerging markets, as also in the US. The US monetary policy is looking at China to see what it should do going forward. India is looking at a big event this month, the Union Budget, which will lay down the macroeconomic framework for how India should progress in this kind of climate, which is not very conducive in terms of global events. To discuss that and a lot more, we have with us Dr. Arvind Virmani, who's former executive director for India at the IMF, former economic advisor, chief economic advisor in the finance ministry, and currently he heads a think tank called Policy Foundation, which looks at policy very intricately. Welcome to our show, Dr. Arvind Virmani. I remember you were on the show some time ago, maybe some 5-6 months ago, and you did say that the way China was going, the global deflationary trends that China was bringing or exporting would take some time to play out. And it's only after that plays out that India would really sort of normalize, the Indian economy would come back into its own. Now that you've seen a lot happen in the last 6 months, and especially beginning this year, a major scare coming from the Chinese markets, what's your sense? How long will these global headwinds take to play out?
So there are really two parts to the way I look at it to the China story. One is what is actually happening, and second, how other people are looking at it, understanding it, and reacting to it.
Okay.
So let's take the first part, the reality as I see it. In my view, Chinese economy is going through a hard landing.
Okay.
You know, people hate, they keep saying, no, it's not hard.
You're right. A lot of people are refusing to use this term. Yeah.
Afraid to use this term. So
George Soros is the first to use it. Yeah.
But that's right. I was inspired to do it after him because everybody has their own definition and they keep changing. So I have just written a blog on this, but anyway, the essence of it is that 90% probability over the next 3 to 5 years, the economy of China is going to go down to below 4.5%.
Okay.
But the exact number doesn't matter because the second part of it is too many people just didn't believe, 3, 4, 5 years ago that China would slow down so dramatically from 10% to 4.5%. So they are going through these contortions in trying to adjust, which makes things even more difficult and uncertain. So part of it is...
So you're saying 3 years it might take for China to go down to 4?
My best guess is 3 years, but definitely by 2020, okay, below 4.5. So there's part of this adjustment where, for example, people who are invested inside the Chinese economy are very scared. I mean, let us be very frank. To say anything negative about China.
Yeah.
So that creates its own problems because nobody really says what is the truth except perhaps George Soros or somebody like him. So what is the implication for us? I think I must say that in some ways I had said it'll take a year or 2 years to play out on your show. But I think it may take longer because this confusion and this continuing decline. That time I was talking about a little below 6%, which I was pretty confident was happening.
Okay.
But now I'm kind of making a bolder statement. So what are the implications for India? We can discuss that.
So tell me, point number 2, if China takes, if India takes longer to adjust, say if China goes down to say 5.5%, say in 2016, for instance, that will be a full percentage point below its last year's growth. Right. What impact will it have on India? Number one, and how should India look at its own budget making, policy making process? That's what I want to know from you.
Right. So the first part is that growth is slowing, and that whole process of deflation is going to continue. That's why we have already seen action like the MIP on steel, etc. This problem is going to continue for at least a year or two.
MIP as in the minimum
import price for steel.
Is that a good thing?
Well,
because there are a large number of steel users.
Yeah, you see, but yes.
How do you push Make in India?
So MIP really affects the duty, so the duty is not levied. Let's say the MIP is 20 and somebody says I'm importing at 10, the duty is levied on the 20.
Yeah, okay.
So it's an acceptable way when people feel that the minimum cost of production is 20. So in effect, this instead of every time levying an anti-dumping duty, you just put a minimum import.
But isn't there a problem here, Dr. Virmani?
Yeah.
It almost amounts to saying that if globally cheap steel is available, it need not be passed on to the consumer. So government puts a duty, like in the case of oil, they put a duty, and the government can claim that, well, we are collecting duty to drive public investments.
That's a good question, because oil and steel are very different things. Oil has what we call resource rents in it.
Yeah.
So the rents just decline. So there's no real way to calculate what is the cost of production of oil. But for steel, there is. We know the market price of oil, coal, and iron ore. Take the depressed prices. But even on those depressed prices, there has to be a margin. You can't sell the steel. If you're selling steel at below what the cost of materials is, then I think it's justified. Now, I don't know the exact calculation and I wouldn't vouch for it, but the principle in such an extreme situation is valid. So that is one thing. So the thing is, this deflation is what is hurting us. And it's hurting what I called, I think in your show only, the first time, of course, I've written about it, what I call the globalized corporate sector. So you see this divergence between...
you separated those which are globalized and those which are not.
That's right. The globalized corporate sector will continue to suffer. There is not much we can do just with domestic policy, except these kind of...
which, by the way, which dominates the Sensex, the globalized...
Exactly. That's the whole
therefore,
point.
the Sensex is also
So what
depressed.
I've been urging is, please do not lump these two together. It's a different world. That's why I keep emphasizing China, the deflation coming. That deflation really hurts this globalized corporate sector, and that is why you're seeing their growth is not keeping up. It's much... People keep talking about the disconnect. My point has been, please try to understand. At least this is what I believe is the reason.
And which is what Dr. Virmani reflects in the top 500 companies.
That's right, absolutely.
Not having had any sales turnover growth this year, zero. These are all globalized.
Absolutely, the deflationary effects are very strong, and we can go to monetary policy also because there is implications.
So tell me now, given the situation, what sort of budgetary or tax policy would you prescribe? We'll come to monetary policy later.
Sure.
To really sort of fortify India, Indian economy. Now, there's one debate that's going on in the government today is, since private sector investment is not picking up, should we boost public investment further? And in that context, should fiscal deficit, lowering of fiscal deficit, the roadmap, should there be a pause? And should we just keep fiscal deficit at about 4% and not really go down to 3.5% of GDP, as was the roadmap established about a year and a half ago, because things have changed. Now, where do you stand on this debate?
So first point I want to make is that when I look at macroeconomic conditions, I look at both monetary and fiscal policy together. So the mix, in my way of looking at it, is very important.
Okay. So you first talk about fiscal policy, then you can talk about monetary.
So all I want to say is, because that gives me two recommendations on fiscal. So my overall view is that was from last year, and we'll see whether it should or should not change. So my view last year was that I opposed the changing of the target, because I thought the monetary policy should loosen and the fiscal policy should remain on target. Okay.
In a way, fisc should tighten, monetary should loosen.
Okay. So that's why the mix comes in. But the second point of it was, within those targets, there should be a shift from what we call consumption or transfers, which we'll probably talk about, to investment, for precisely the reason which you outlined. Given that investment in the economy from corporates was so low, it was clearly necessary that government shift from consumption to investment, because the effect of that would be a higher multiplier.
Okay.
Consumption or transfers also have multipliers. But my whole argument was that in the current environment, there would be a much higher multiplier for investment, so government should shift the focus.
Okay.
This second part of it remains valid today.
Okay.
So let's go to, is there a reason to weaken the target?
Okay.
My first, or what they call first best...
Weaken the fiscal target.
Fiscal target, My first best policy is no if the monetary policy continues to loosen. What, unfortunately, in my view, the monetary policy has tightened implicitly because of this global deflation.
Okay.
And one simple indicator of that is the WPI. It's been stuck at minus 6%. That is an amazing thing. As far as I know, it's never happened before. And why is it happening? It's because of China factor, which we just discussed.
Okay.
Now, if the monetary policy is not going to loosen, as seems to be the case, then I think there is a case for perhaps loosening it a little bit, the fiscal policy.
So do you buy RBI Governor Raghuram Rajan's argument that he has loosened it to some extent, but it's not got transmitted because banks have a problem, and monetary policy loosening interest rates or loosening money alone is not going to kickstart the economy? The central government has to do a lot.
Yeah. Unfortunately, I don't. Okay, there are three points here. One is before I came back, I had done, I had seen papers in the IMF, etc.
Plus, he's also saying that sequentially, month to month, inflation is back up to about 7%.
So that will be the final, because that's a slightly trickier question. But let me just make about transmission. One has known that transmission is always slow. That's part of the transmission problem which we have been talking about for ages. It's not something new.
And
if it has become worse, okay. Then
because of the bank NPAs and
yes,
bank
that's
credit,
right. But it's not as if it used to be great and we should have made a policy structure or monetary policy assuming that we'll have great transmission. That is not the way to run policy. But perhaps it has become worse, and the case must be made for that. Okay. Second one is that if you look over the last 18 months, the inflation rate has fallen by something like 9 percentage points. Okay. So I say, okay, let's take benefit of the doubt and just focus on core inflation. The total inflation has fallen drastically. So the real interest rate has gone up dramatically.
Okay.
We cannot ignore that. The economists for 20 years, monetarists have been lecturing us that don't look at the nominal values, look at the real, which is nominal minus interest rate. Okay, they always used to say this.
Nominal minus inflation.
Minus inflation.
So what do you reckon is the real interest rate today?
But even the core inflation has fallen by about 2% points. So at least one can adjust the policy framework by at least 2%. I'm not saying adjusted by 9%. Okay, so 2% means we've had 1.25% decline in repo. So in my way of looking at it, there's a safe gap of 0.75 still there. So that's the second point. The third point is you say, okay, ye to past hai. What about the future? Yes, that point comes in there. What is the future? Let me tell you, 6 months ago, in the committee, I said that there was, I don't remember the exact...
You and the Monetary Policy
Committee, that there is a 60% probability that end of March inflation, CPI inflation, would be between 4.5 and 5.5. I'm still sticking to my... and we'll see. So, you have to, you can have different views, but as far as I'm concerned, I have been right. On the recommendations I have made. We are meeting that forecast.
But tell me, I want to ask you something here. Today, private credit rating agencies who are also looking at bank balance sheets, right? And many other experts now reckon that the actual amount of stressed loans, which the banks are not actually revealing, could be in the region of 15 to 20%. But officially, banks are saying that NPAs plus restructured loans, which is a euphemism for, again, loans gone bad but got reached, they're admitting that it's 10% plus. But actual numbers, people say, could vary between 15 to say 18. Now, if 15% of the total credit is either gone bad or about to go bad, it stands to reason. You could argue that the bank capital, which is about 10-11% of the total credit, that's what banks keep as capital, it's got wiped out, right? So don't you think the government, as a reform, government is the owner of all the banks? They're a bit late in recapitalizing banks.
Absolutely.
Because if they had recapitalized banks a year ago, in one shot, like the Chinese did in 2003-04, they put $80 billion in the banks. Why didn't the government do it?
Okay, very good question. So early in 2014, I remember I had a paper, there were other people who were putting this issue of bad loans at the top of the list. It wasn't on the top of my list, I'll say very frankly, in January or December 2013, January 2014, but I had it in my list. So I think this is a very good point. I think it's been too little too late. And frankly, both government and RBI, at least as outsiders, I don't know the internal debate whether RBI raised this issue, when they raised it, etc. But as far as I am concerned, looking from whatever information I have, I think both government and RBI must take some of the blame. You are absolutely right. They should have started acting from the time the government was formed,
and Mr.
which is
Virmani,
May 2014.
Today,
right?
as we speak, Punjab National Bank, the second largest bank by deposit, has announced that its provisioning has gone up by 40-45%. You know.
Let me just add one more thing. No, that's valid. Why? Because it takes time to resolve these issues. That's why they should have started right away. That's what I'm saying. It's not that you can resolve in 1 minute, that they should have resolved within 2014, right? But they should have started. They should have appreciated the extent of the problem. That is what is sad.
So there was a tendency to kick the can down the road.
Somehow it will work out. And that's why I'm saying RBI presumably should have better information and more judgment about this. One can say that maybe the government didn't know and therefore didn't bother.
But some might argue that Raghuram Rajan has been warning the government.
But from when?
For 6 months, 7 months.
But 6 months, now it's happening. I remember, we said it should have been done right in the beginning. I am saying it was on some people's list in 2014, January.
Okay.
I remember reading, I can mention, but I don't want to individual name. I remember.
So tell me, what should the budget do about this problem? Since bank credit has to be... Banks have to be restored to health so that credit picks up.
Right.
Because there's no point cutting interest rates if banks cannot transmit.
Absolutely. So the medium long-term problem now, solution everybody understands is the bankruptcy law. So we shouldn't forget that in coming to the short term. But the short term is well understood. There's been Asian crisis, European crisis, American. There are so many examples out there. You've got to capitalize. You've got to work out a way.
So there's some talk of creating a national asset reconstruction company which takes over the bad loans and 30-year government debt is issued so that this problem can be resolved over a longer period.
Right. So I'm a little uncertain on this. We've created ARCs have been allowed, etc. We've gone through this process even while I was here, 4 or 5 years ago. The thing is that didn't work. Usually a bad bank type of thing is created when there's a huge crisis, like our BOP crisis or the Asian crisis. In fact, in European case, when I was at the IMF, I was telling them to look at some of these things because the Euro crisis is of that nature. Now, I am not sure that the Indian crisis cannot, it requires that kind of an extreme step. If it's formed, I'm not saying it will not help, but that is really the kind of thing you do after a big crisis, and there is no crisis.
But here I want to point out another thing, Mr. Virmani. Again, taking off from what you said earlier about the impact of China, negative impact of China, now may take more than a year to play out. Earlier we had discussed a few months ago.
At that time also I'd said a year. So
I'll tell you how that connects to the problem with the banks. There's a research firm called Credit Suisse which has given a list of big companies, groups, whose loans are stressed, seriously stressed, and they're all companies in the commodities and infrastructure sector who've been affected by the China slowdown. And the total loans of these 10 companies, groups, is about 7.5 lakh crore. And of that, private credit rating agencies are saying that about 3.5 lakh crore would qualify as nearly default status. And these 10 companies have an earnings before interest and tax, EBIT of about 45,000 crore. Imagine a total loans of 7.5 lakh crore, and if you take an average of 10%, interest that they're paying, they would probably be paying 75,000 crore annually, but their actual earnings are just 45,000 crore. Now, again, this is linked to China.
Right.
Now, how long will this take to play out?
Just to refine that a little bit, see, there are really two parts to it. One is again the tradable goods, and then there's the infrastructure. Infrastructure is not tradable. So everything you said applies to the tradable goods part, which is your metals, mining, and those kind of sectors.
No, what I'm saying, these group companies are in commodities and infrastructure.
I know, but the solution may be different. So I'm just trying to, as I said, I'm refining.
Because under RBI guidelines, they cannot take fresh loans for infrastructure.
So what I'm saying is the first part, you are absolutely right, is linked directly to China and will not be sorted out, exactly your point. But be careful, don't lump everything together is what what I'm saying is that the infrastructure problem was created by us because I still remember, again, I won't name names, of saying, please, this will not work unless you have a proper policy and regulatory structure. So unless you sort out the policy and regulatory structure, the same problem will come back. So the focus there has to be on policy and regulation, number one. The second problem was, again, I can be very open, I'm no longer in government, was this whole issue of public sector banks being phone call type of thing. We need not go deeper.
What somebody called phone banking.
Yeah, phone banking. So these two things have to go. No, otherwise it won't be solved. So there is a slight differentiation between these two types of things. I think government is acting on the second part. The first part is a little tricky because, they call it moral hazard, commercial. How much of the blame for misjudging international things should be taken by government, etc. Perhaps some sharing arrangement could be useful there.
Okay. Tell me, Dr. Virmani, you have produced so many economic surveys in the government when you were Chief Economic Advisor, and you've also given inputs for the budget over 6, 7, 8 years. What should be a realistic GDP target for 2016-17 in the union budget?
Good question. So, if I may be allowed to brag, in the last 2 years, I had the 2014-15, I said the increment in acceleration in growth would be 0.5%. It was 0.6. In this one, I have said again 0.5. According to the new projection, it will be 0.4. So, by and large, over this 2 years, I've, on average, I've been completely spot on. Now, what about the next year? Now here,
given the China effect and all.
That's right. See, the key 2 or 3 key policies which we kind of discussed, but let me summarize those. If those go right, then I would be bolder. I think we can get a more than 0.5, let's say 0.75 or so increment. But if we don't get those right, then it would actually be less. Less, okay.
Because some economists are saying there could be a deceleration if these policy reforms
I don't expect a deceleration. Now, it may not come out 7.6. That's why it's...
So what are the two policies?
Okay, so two or three things we discussed is, one is this fiscal monetary mix. I think is very important. Okay. Without it, it won't work. Second, of course, is the monsoon, which we kind of 99% we can assume it will be normal. Because here I admit freely that I misjudged, even though I have dealt with the 2 droughts earlier. I misjudged that 2 in a row have a much more devastating effect than 1. And it's not just additive.
I know.
It's a multiplier.
And the third?
So the reversal will actually bring a boom in agriculture and rural consumption. And the third, but that is that little bit of uncertainty is there. And the third, of course, is the bankruptcy and dealing with these things. They have to be dealt with. They are not going to get sorted out automatically.
The bad assets.
The bad asset thing.
So if these three things happen...
Are kind of critical. Of course, the general one is always there. The structural reform must continue.
So if these 3 things happen in the right way...
Then it could be a bigger jump.
0.4%.
That's right. That's right.
Okay. Thank you very much for talking to us, Dr. Arvind Virmani. That's all we have in this edition of State of the Economy. We'll be back with you next week. Thanks for watching.